China is boosting its reserve requirements for banks by 50 basis points this morning. The idea being, of course, to cool inflation in the country. Stephen Green is with us now. He is the head of China research at Standard Chartered. He's joining us by telephone. Stephen, so glad you could be with us. In a note to me this morning, you said, don't freak out. This is normal. This is just China managing for the second time this month liquidity in its country.
Yeah, very much so. It's going to be once a month in the next few months, and Chinese New Year, it's especially important to do this kind of thing because you have a bunch of liquidity flooding out of the system. This week, everyone's taking cash out to pay presents to their family and friends for Chinese New Year, and then that cash floods back into the banking system the week after next. So raising the reserve requirement is a very good way of taking that out of the banking system again.
And yet, Stephen, you saw the immediate market reaction when we heard these headlines just over an hour ago. How does China manage what the world expects from China versus what it needs to do?
Yeah, this is very tricky, and we're going to have some tricky, volatile times over the next 3 months, 4 months. CPI is going to be moving up in China, but we don't think there's going to be an inflation blowout, and at the moment, the leadership doesn't think that either. So this is all about managing the liquidity, deflating the property prices a little bit as well, but not derailing growth. It's a very fine line that they're trying to go. Many folk in the global markets think that China's a huge bubble, and it's just about to crash, though. So the markets take every little bit of news like this very, very nervously.
So, Stephen, do you think that China itself is worried about a bubble? Is that why it's doing this?
Yeah, there's certainly a lot of concern right at the top of the leadership about property prices. What tends to happen in China is that they'll move on the sector, prices may come off 10-20%, then they'll stabilize, transaction volumes will just dry up, and then we'll have a year or two where the real estate sector just some of that capacity is absorbed, and then we'll be off to the races again maybe in 3 years, 2 years' time. We're not looking for a systemic collapse in the market at all.
Speaking of markets, very quickly, Stephen, we've already seen this year stocks in Shanghai sell off much more than here in the United States. What markets are you going to be watching most closely in the next few months as China continues with this strategy?
Well, I think it's going to be very interesting. By around May, June time, we're going to have a better feel of exactly how much inflation there is out there for China. And you could very well find that if expectations begin to turn, 3-4% CPI is seen to be kind of where we're at. I think you could well see a return to some move up in the Chinese equity market, as long as we're assured that we're not going to have an inflation blowout.
All right, Stephen, thank you so much for your time. Stephen Green of Standard Chartered.